The Dow rises this morning through 40,000. Fed speakers see monetary policy working. US jobless claims and factory output data reinforce hopes for a rate cut or cuts later this year. Australia's labour market may be softening faster than the RBA is expecting. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, says China's authorities need to be careful from a financial stability perspective that house prices don't drop too much.
My view is that they have not carefully thought about the impact on price, and that's why I brought up this view that there needs to be having some sort of price adjustment in order to induce the buying appetite again from the household. But at the same time, that will be a huge concern of financial stability.
But first, in 5 and 5 with ANZ, the Dow Jones Industrial Index briefly hit a fresh record high over 40,000 overnight. The S&P 500 also nudged up into new record territory. Markets are more confident the Fed can cut this year after a week of data showing a soft CPI, flat retail sales, rising jobless claims and falling factory output all reinforce signs of a slowdown in both the US economy and inflation, just as the Fed wants. Here's ANZ economist in London, Bansi Madhavani, talking this morning.
Put together this suite of data that we've got recently suggests that disinflationary trends will play out in coming months. We've seen rebalancing in labour market. Coupled that with the data that we've had around improvement in inflation, subdued consumption, it affirms that the economy is cooling off, and it explains why the FOMC will be in a position to cut rates a couple of times in 2024.
In currency markets overnight, the US dollar was up a touch, along with US Treasury yields. The US 2-year up 5 basis points to 4.79%, and the 10-year up 1 basis point to 4.37%. As of 5 a.m. Sydney Melbourne time, the Aussie dollar is down 0.2% at 66.17 US cents, and the Kiwi down 0.1% at 61.17 US cents. Number 2, Australia's unemployment rate rose to 4.1% in April from 3.9% in March. That was slightly above market expectations, but jobs growth outperformed estimates at 38,500. ANZ Head of Australian Economics, Adam Boyton, says that meant a neutral print overall.
What the Bureau of Statistics did note is that there were more people than usual indicating they had a job they were waiting to start in. And so we have seen in the labour force data over the past couple of years now an increasing tendency for people to, often it looks to be waiting until after school holidays or after holiday periods before they start a new job. We saw that a bit in these data. What that tells me is that some of that increase in the unemployment rate to 4.1 will probably be unwound next month.
Number 3, Adam says a 0.8% annual decline in hours worked was an interesting feature.
It's unusual to get a fall in hours worked over the year of that sort of magnitude. Indeed, if I look back over, say, the past 25 years, we've only seen larger falls during the pandemic, the GFC, and the early 2000s slowdown. Now, I don't want to make too much of this just yet because some sort of quirks in the data mean that next month hours worked will probably be up in yearly terms, but I think it does tell us that there's been a substantial easing in the labour market underneath the surface, and given the Reserve Bank doesn't tend to have much of a focus in its suite of labour market indicators, it's possible they may be underestimating the degree to which the labour market has been easing.
Number 4, Japan's GDP contracted 0.5% in the March quarter to be down 2% for the year. ANZ FX analyst Felix Ryan says that was well below expectations for a 1.2% annual drop.
Q4 GDP was also revised down, meaning that the Japanese economy has now failed to grow since Q2 2023. Softness in private consumption and business activity was key in Q1 GDP weakness, as was a contraction in exports thanks to a disruption in mainly car exports. While the factors in export weakness could be viewed as temporary, the softness in private consumption has been persisting for some time. As of Q1, this now marks 4 consecutive quarters of negative consumption growth.
Number 5, the Philippine Central Bank kept its key policy rate on hold at 6.5% yesterday for the 5th meeting in a row. The decision comes after GDP data a week ago showed consumption growth at its slowest since mid-2021. Here's ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur.
The central bank reduced its 2024 risk-adjusted inflation forecast marginally. The overall tone remained predictably hawkish. This outcome is consistent with our expectations, and we do not expect any rate cut in 2024.
Sanjay Mathur there. Now, in our bonus deep dive interview on China's property market, we talk again to ANZ Chief Economist for Greater China Raymond Yeung, who says authorities need to be wary of triggering large price drops while trying to entice buyers.
The politburo statement is only pointing to the needs to reduce the existing inventory and control new supply. But at the same time, they have not mentioned anything about the impact on price, especially for lower tier cities already having a price decline a lot in the past 2 years. And if you really want to induce demand, the supply-demand equation is still pointing to the needs to have a bigger decline in price. Our view is that you have to put yourself into the shoes. Now 30 years bond yields or sovereign bond yields can generate 2.5% investment yield. Then why should I buy property if even the rental yields in the top cities is only about 1.5%? So I believe that there is still a big room for the price to decline so that households are willing to buy property again. And it would even be a need for the price to drop by at least maybe 38% so that the potential investors will be attracted back to property investment again.
So is it possible or likely that in China, if there is a more pure market environment, that the owners of these assets, or in particular the developers or the local governments who have a lot of debt that is valued against these assets, that they would take a big immediate hit and that there would be a clean clear out of these losses in an American-style way?
My view is that they have not carefully thought about the impact on price. And that's why I brought up this view that there needs to be having some sort of price adjustment in order to induce the buying appetite again from the household. But at the same time, that will be a huge concern of financial stability if we see the price to drop and eventually in terms of the value of collateral held by banks, the mortgage portfolio, and also even in terms of the land values held by many investors, including state-owned enterprises. We'll also faced with a downward pressure of the market values of the asset holding. So that is a puzzle for the authority to solve. And I believe the central government would not like to see big decline in property values and asset values, including land value. And in the first-hand market, the primary market, which are the properties sold by property developers, will still be governed by the local authorities in terms of the pricing, and they would not let the developers to sell their property or the inventory on hand with the price of, if it is too low, then I think the local government will intervene and prohibit the price cut by the developers. But what they cannot do is the second-hand properties. So we have seen in the past 2 or 3 months that the transactions of the secondary market is actually better than the primary market. So if there is any price adjustment, I think that will start from the secondary market first.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 17th. Catch you next week with the Reserve Bank of New Zealand rate decision on Wednesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.